Hello, everyone. I am going to assume that the technology is working. I don't see, from my perspective, but I'm glad to join you all. I am here in Washington, D.C. The data, fresh data that I shared with the reporters this morning was to show that it's been a difficult condition throughout 2022. I mean, we started out this time last year, multiple offers were quite normal. And by the second quarter, things began to calm down a bit. And maybe it was welcome because multiple offer, as we know, it can be very frustrating for non-winners. There's only one winner and multiple losers, and it's not fun to be on that losing side to repeat the home buying process all over again. Third quarter was very concerning, continuous decline. And the fourth quarter that's recently completed is quite ugly, and in fact, you can say painful. So now we are in the new year, and what to expect given that market condition is still a lot of uncertainty. There's talk of economic recession. We see the headline of many workers from technology sector, from Wall Street getting laid off. So what does all this mean for the housing market as we go forward? So all this, I speak better with the PowerPoint slide. So let me put this onto the screen. And again, I am going to assume that technology is working. And in fact, I need someone to make me a co-host so I would have that share screen capability. I don't recall visiting Prescott. I've been to Phoenix, of course, and then I visited up to Flagstaff, and I know Prescott is right in between. Maybe I should have stopped by, at least get a little feel for it. So next time I'm in Arizona, I will make a note to stop by Prescott. So let me see if I have the share screen capability, and yes, I do. So let me put that onto the screen. Okay, there we go, but let me go from the beginning. So, all right, great. So home sales activity in hindsight looks like the following. I put three boxes. The first box is 2019 before the arrival of the ugly COVID. So if we look at pre-COVID condition, sales were moving modestly up or modestly down, no real excitement. Then COVID hit, we were uncertain as to what's gonna happen, but what do you know? People wanna buy real estate, they wanted to buy real estate, and we had a COVID real estate boom for almost 2 years in 2020 and 2021. Then everything changed in 2021, 2022, just last year. January was fine. February decline, March decline, steady decline, 11 straight months of home sales decline. And that is simply due to continuous rise in mortgage rates. Mortgage rate went from 3% beginning of the year to 7% by November. So all this killed off the buyers. They looked at the mortgage calculator and numbers simply do not work. So this shows how influential mortgage rates are to the housing market. So steady decline. If we look at the annual basis, annual figures looks like the following. I know some of you in the audience, maybe you entered the business only the past 2 years or 5 years. You have only seen the upturn until this past year of 2022. But there are other times in the housing market where there was a big plunge. And in fact, it happened in 2007, 2008, when the subprime lending imploded. It blew up. We had a massive foreclosure crisis. And in fact, Arizona was a hotbed of foreclosures back then. So very low home sales activity along with messy condition foreclosure, declining home prices by 30%. And I think some places in Phoenix suburbs down 40, 50% in prices. So the middle of the graph show you depressed home sales condition back then. Home sales today are matching 2014, just as we were just coming out of the foreclosure crisis. So it's been a big decline. But one unique thing about this condition is we don't have foreclosure crisis. Homeowners are quite happy. So unlike the foreclosure crisis of last round, we just have lower sales activity and not real meaningful decline in home prices. In fact, here is the data that I collected from Prescott Area Association of Realtors. So as you look at this data, first on the very first column, the total sales, as you can see, following the national trend, lower close activity this December compared to last 12 months prior. And then you see the active inventories are higher, month supply is rising, median prices, essentially the same as last year, no meaningful change. Again, no crisis. And in fact, you may even say, wow, $445,000. These are substantially higher compared to pre-COVID in 2019. So homeowners in Prescott region, they are smiling. They're saying, I built housing wealth over the past 3 years, and I feel comfortable. But realtors, mortgage brokers, home builders who are in the market to conduct business, you are feeling the pain, but not the homeowners. Homeowners are doing fine. I put that little red circle to highlight something interesting. If the home sales are plunging, then surely we would have a large degree of inventory. And total inventory on the market is higher, but the fresh listings, the new listings that's coming on is actually slightly lower now compared to before. Very interesting, implying that there's no distress among homeowners. Homeowners locked in at 3% mortgage rate, they are loving it and they don't want to give that up. So fresh listings are not happening. Therefore, if there are some buyers who want to buy and they are not satisfied with the current inventory choices, then they're looking for the fresh listings to pop out, but it's not popping out. And that's the difficulty. So first, we don't have that many buyers, but among the buyers that we do have, they're looking for the fresh listings, but the fresh listings are not occurring. And hence, we have this standoff and much fewer transactions. Given the price run up, $445,000 in the Prescott area region, a lot of discussion, everywhere across the country, about 40% increase in home prices over the past 3 years. So is home price crash inevitable given the sales are falling? I mean, sales are falling. Home prices so far is holding on. So is home prices inevitable? And you see large degree of coverage in the media, tumbling housing market may be a price correction on the way. Your clients are reading this. So to better prepare your argument with your client, just share some factual information. Facts are facts. Rather than trying to predict what the home prices may do, let's compare. The first line, job cuts. Well, back in the last housing cycle, I'm talking about 2007, 2012 period. I mean, almost 5 years of downturn. During that time, there was 8 million job losses in the country. This time, we know Amazon is laying off workers, Microsoft is laying off workers, mortgage brokers are losing their job, but there's still job creation. And in fact, you see Help One Assign, so on net, there's no job losses. Job creation is outpacing job cuts, so no net job losses in the current environment. Big difference. How many people receiving steady salary, W-2 statement salary? It is 23 million more people receiving salary today versus last housing cycle. What about independent contractors like you who have fluctuating income? Well, if we include everyone, then it is still 20 million more people working now compared to back then. Subprime lending, widely prevalent during last housing cycle, this time, not available because of new government regulation, sensible government regulation on ability to repay. You must demonstrate that you have the income, You have to show the documentation so that you can repay the mortgage, other than, say, if you were to lose your job. So this is indicating that, that we don't have those risky, shady mortgages in the current environment. What about home building activity? Are we overbuilding? So 5 years prior to the cycle, how much building activity? And last housing cycle, way too many homes were being built. This time, much more restraint. Inventory, we don't have enough. Mortgage delinquency rate, very minimal. Foreclosures, almost non-existent. So these are factual information, and one need to consider factual information before beginning to answer or trying to gauge whether or not we would have any meaningful home price crash decline conditions. In fact, here's one of the graph. Mortgage delinquency of 90 days or longer, meaning not 1 month, but people who miss mortgage payment for more than 3 months. So how many are there? Middle of the graph shows 2008 condition. So very, very large number of people defaulted on their mortgages. When we had COVID, the second circle, there were some people who really did not know what's going to happen. So they said, I don't want to pay mortgage just in case, the condition. But once the economy reopened, people had their jobs back, people start paying mortgages. So mortgage delinquency rate at historically low levels. Inventory. Current inventory nationwide, which will be very reflective of what's happening in Prescott, is that it is up from 1 year ago. Yes, we have more inventory. But even with this increase, it is still lower compared to 2019 and substantially lower compared to when we had the housing crisis. So we have only 1 million homes available for sale versus 4 million back then. So if we have a shortage, prices simply do not decline or any meaningful decline when there is a housing shortage. And that's what we are today. Very interesting graph on this one. Blue line is housing asset valuation. So this is showing that what is your home value? What is your neighbor's home value? Let's add up all these home values across the country, and what do we have? And according to the Federal Reserve, it is the blue line. So that is the housing collateral value across the country, record high. You see in the middle, a little fluctuation, that's the foreclosure crisis, but right now it's record high. The red line is mortgage borrowing. How much mortgage debt is out there in the country? So you see that mortgage debt has been very neutral throughout this increase in home values. So you can say the gap is the housing wealth condition. And home prices are not rising because of excessive borrowing. There is no excessive borrowing in the current environment. Home prices increase because of housing shortage, not because of excessive mortgage debt. So this is again showing fundamental difference. We are on much solid foundation this time compared to the past. And the likelihood of a housing oversupply is simply not there. From 1960, some of you were not even born back then. So I'm looking at very, very long term. Housing starts, single family home construction, how many? Blue line is the historical average. Some years is above, other years is below. Housing sector is cyclical business, it goes up and down. But look what has happened in the 10 years prior to COVID. I put that rectangular box, 10 years prior to COVID. We have been underproducing for 10 straight years. We had a housing shortage before COVID. Then the real estate boom of the COVID really exacerbated multiple offer situation. Right now, it doesn't feel like we are in a housing shortage, but let's say the buyers come back to the market. If the buyers come back to the market, we will again encounter housing shortage. That's why it's critical that we need to consider we had a housing deficit and we need to produce more, to compensate for multiple years of housing deficit. Apartment building in the meantime is a little different. There's an active apartment building, in fact, overbuilding in the apartment sector. So if you're a real estate investor, maybe you have a rental property in the Phoenix suburbs or something like that, don't expect rent growth to be strong anymore because apartment supply will soon reach the market. All these vacant units will hit, which means that it's going to be hard to find a new tenant given the competition on the supply. In fact, the rent forecast is that 2021 and 2022, very good year for rent growth. So you are a real estate investor, you made some money, not only from home price appreciation, but from increased rents. But this year, rent growth will be much milder, below consumer price inflation, because apartment supply are really coming onto the market. So I mean, I put apartment rent in the title, but you can also still view it as a single family rental condition. So if you are a real estate investor, how much rent growth? You may not be getting all that much. And I'm sure that some of you may even say, right now, I don't have a tenant, and I may have to actually reduce rent in order to attract a tenant, because tenants are looking at other competition of new apartments, new supply that's coming onto the market. But here's some hopeful sign that the worst in home sales is coming to an end, because mortgage rate have been declining for several weeks. Mortgage rate peaked in late October, early November, when it went above 7%. Again, just going down the memory lane, January of last year, mortgage rates were 3%, then steady increase such that we surpassed 7% by November. But since then, it's been coming down a bit. And I think there's a chance that it could go down even further. So it's beginning to stir some interest among people who got priced out. They said, I cannot handle 7% mortgage rate, but now mortgage rate close to 6%, they're retyping into their mortgage calculator to see what it would be or whether or not they would return to the market. And I am even more hopeful that there will be even further decline in mortgage rate because of the following chart. So let me explain what this chart is. The blue line is government borrowing rate. I am 3 blocks from the US Capitol. They're debating about the national debt, and certainly we have to address that. It has really risen tremendously. We have to address that situation. But when government borrows money, they pay the interest rate on the blue line, while the red line is the mortgage rate. Mortgage rate and the government borrowing rate move very similarly because many mortgages have government guarantee. Veterans Affairs mortgage, government guarantee. FHA, government guarantee. Mortgages originated by Bank of America or by Quicken Loans, well, they get sold to Fannie and Freddie, which Fannie and Freddie is guaranteed by the government. So all this government guarantee is assuring that middle-class American would have access to low interest rate, not much different from the government borrowing rate. So two lines move very similarly together. But if you look at this graph under a microscope, something funny is happening. Look at the spread between the two, the gap between the two lines. And this is the gap between the two lines. So I put the gap. The blue line is the average of those gaps. So there are times when the gap is abnormally high. Like today, it is abnormally high, but there are two other occurrences on this graph. In the middle is 2008, when Lehman Brothers, one of the major Wall Street companies, blew up and it went bankrupt. And there was a scare in Wall Street. Was Goldman Sachs going to be the next one to blow up? What's going to happen? So that uncertainty caused this wide spread. But then it disappeared. That spread disappeared within a few months. The second large spread towards the end is the early months of COVID. COVID came, we didn't know what to do. We were stuck in the basement. What's going to happen? Uncertainty caused a wide spread. Today we have widespread. What is the reason? There is not a good reason. So, but one thing we do know is that once there is this wide abnormal spread, it disappears. Let me put it simply. Mortgage rate, according to Freddie Mac, this week averaged 6.1%. And you said, that's not bad. because it was 7% in November, 6.1% is not bad. But if we had a normal spread, guess what? Mortgage rate today should be 5.3%. And can you imagine the wonders it would do for the housing market, for the buyers, if the mortgage rate were 3%? So I'm hopeful that this abnormal spread disappear, and in the process, bring the mortgage rate down to about 5.3%, sometime in the summer months. So some steady decline in mortgage rate that will open up the gates for the buyers to begin to consider coming into the market. Is not going to be a drastically opening of the gates, but some opening of the gates so that people can retry to enter the market. In fact, what we are seeing in the mortgage application to buy a home, so only the purchase mortgage applications, it was declining throughout 2022, just like home sales were declining. But first, we need to stop the bleeding before turning upwards. So it looks like we are stopping the bleeding. And what do you know? This week, we saw a meaningful uptick in mortgage application. Maybe the falling mortgage rate is beginning to stir interest among some buyers, and this could continue to increase once the mortgage rate continues to fall, which I think will happen. So at least we have stopped the bleeding on the mortgage application. Let me now quickly turn to the job market and then wrap it up with a forecast. Job numbers from early months of 2020, right before COVID, and then you see the big decline, that's the COVID lockdown. Then ever since the lockdown, job gains, job gains, job gains. Today, we have record number of Americans working. Some states are doing better than others. Arizona, I'm not sure if someone in the back can see it, but Arizona is showing 4.2%. So what is that 4.2%? It means that in Arizona, there are 4.2% more jobs today, or the latest available information, 4.2% more jobs compared to March 2020, right before COVID hit. So Arizona is doing reasonably well. Texas is doing well, 6.0. Florida is doing well, 6% growth. The best ones are Utah, close to 7%, and Idaho, 7%. California is positive, but only by 1.4%. But there are some negative states. Negative means they have not fully recovered those lost jobs. So those would include that orange color states. New York being one example, down 1.8% in New York. So some states doing better than others. Arizona would be one of the top performing states, even though there are a few other states doing a little better than Arizona. If we look at Prescott specifically, it looks like the following from year 2000 to the most recent. So from year 2000, there were only 50,000 residents in your area with jobs, or I should say payroll job, meaning W-2 statement jobs, only 50,000. Then it increased. Then foreclosure crisis came and people lost jobs. Then after the foreclosure crisis were out of the way, then job creation, then COVID hit. COVID knocked it away. But look at this, record high number of jobs in Prescott today, higher than pre-COVID, and 70,000 residents now receiving W-2 statement salary. So in this 20-year time span or 22-year time span, 20,000 more people with job in the Prescott region, which means these are high housing demand. So people would be buying a home. Office vacancy rate, just one little commercial real estate data, is rising, rising, rising. I am in Washington, D.C. Traffic jam is almost non-existent. Offices are empty. Federal government employees are pretty much working from home. People are not coming to office. San Francisco, whether it is because of crime or dirtiness, people do not want to return to office. And of course, they are laying off people in the technology sector. So we are seeing this increased office vacancy condition, so that if you own commercial real estate buildings, especially office, you have to reduce price to get the deal done. Without reducing the price, no one would be interested. But I also show this because it has implication for residential market, especially Prescott, where you are not too far from Phoenix. Because increase in office vacancy rate just means that, well, maybe people don't have to return to office every single day. Maybe it will be some kind of hybrid. Come to office 2 or 3 times a week. So if they have to commute only that many times, they said, you know what? I'm going to live in Prescott. It's much quieter, fresh air compared to Phoenix. I know I have to go to Phoenix every once in a while, but I can work from Prescott. So you may begin to see some workers from Phoenix beginning to wanting a residence out in Prescott. So this trend, in other words, I'm saying is, it is a good trend for you, even though it's a bad trend for office real estate holders or for, say, expensive markets like San Francisco, Los Angeles. But this is good news for you, because if you don't have to return to office every single day, people may consider Flagstaff, Prescott, another destination, because this is a new trend that is developing about residential choices from people not returning to office on a full-time basis. So my forecast, this is a quarterly forecast from 2019. So 2019 and 2020, and then I put the box to show 2022 last year on a quarterly basis. Red box is the forecast for this year. I think we are at the point of a low point in unit sales right now. And there will be increase in sales for the simple reason I believe mortgage rate will decline. Again, that abnormality that I mentioned, the spread, that abnormality will disappear. That will make mortgage rates lower. That will induce more buyers. So I think the worst is over. But if you look at the total box, blue box total and the red box total, it is still a little lighter. So in other words, even though the worst may be over for sales, we cannot match up with the good condition of the first half of last year. So even though things are improving, we cannot match up. Consequently, the annual forecast looks like the following. So let me start from the first line. 2019 pre-COVID, nothing interesting. 2020 COVID, well, increased unit sales, prices boom, so the revenue, the real estate industry revenue grew double digits. 2021 even better. But everything changed in 2022 because of higher mortgage rates. So sales came down 18%, sizable decline. But home prices on an annual basis were still up because January, February, again, multiple offer situation. So if you look at not December, but annual, it was still a good number for the annual. So the revenue decline was only in a single digit. And this year, 2023, I showed you that even though we may be at the low point on the unit sales, we will see some increases, but that increases will still be insufficient to match the total annual figures. I think it will still be down. Home prices, essentially no change. Maybe half of the country will see some mild price declines. Other half of the country will see some modest price gains. San Francisco, definitely large price decline, minus 15%. I think that's almost guaranteed. Midwest, like Indianapolis, almost guarantee positive prices because it's so affordable. Prescott, a little hard to say. Phoenix, a little hard to say, but I think it's going to be close to zero condition. But it's going to be a little above or a little below. Nothing about large price decline. Then in 2024, I think with the recession talk out of the way, I think there will be a steady improvement in home sales condition. So thank you very much for giving me a chance to share some of my thoughts with you all. And again, thank you very much.